Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll continue my breakdown of what is an RRSP and how to invest in your RRSP to minimize your tax bill and maximize your long-term growth. This is part 2 of my RRSP series. In this video, I'll go over the rules for withdrawing from your RRSP, either before or during retirement, and I'll go over how withholding taxes work. Make sure you check out part 1 of my RRSP series first. So click the pop-up at the top right, check out part 1 first, and then come back to this video. In part 1, I went over the benefits of an RRSP, who is eligible for an RRSP, the contribution limits, and the rules to follow regarding tax deductions. This is the 4th chapter of my Canadian tax guide, so I'll be assuming you have a basic understanding of taxable income, tax brackets, and deductions. If you need a refresher on how Canadian taxes work, click the pop-up at the top right to check out my previous videos on Canadian taxes. I'll also be comparing the RRSP to the TFSA, so make sure you check out my TFSA video as well. Picking up where we left off in part 1, the RRSP is the Registered Retirement Savings Plan, and it's a tax-sheltered account designed to help Canadians plan for their retirement, so it's focused on long-term investing. As a quick recap, the RRSP covers 2 main benefits to Canadians. 1, it allows you to defer your taxes to a future year, ideally when you retire. So when you put money into your RRSP, you can reduce the taxes you pay this year and delay those taxes by 30 years until you retire. At that point in retirement, you should have a smaller income, so you should be in a smaller tax bracket, and so you'll pay less in taxes than you would during your working years. In part 1, I focused on reducing your taxes using RRSP deductions. In this video, I'll be focusing on how you actually get taxed when you finally do withdraw that money from your RRSP, ideally when you retire. The second benefit of the RRSP is that it allows your investments to grow tax-free. The RRSP is tax-sheltered, so any income you earn inside your RRSP will not be taxed. So any dividends, interest, or capital gains you make will be tax-free, and so your investments will grow much faster inside an RRSP than they would in a non-registered account. Let's focus on withdrawing from your RRSP. Remember, contributing to an RRSP is a deal you make with the government. You're saying, I don't want to pay a large tax amount right now. I'll delay these taxes by 30 years and pay a much smaller tax amount when I retire. During these 30 years, my investments are growing tax-free. But when I finally need this money and I decide to take that money out of my RRSP, then I pay taxes on this withdrawal amount, and this gets taxed as regular income. Contrary to popular belief, there's no explicit penalty for withdrawing your money out of your RRSP before retirement. You shouldn't do it because you'll be losing out on the long-term investment and tax-saving benefits of an RRSP, which I'll get to, but strictly speaking, you can withdraw out of your RRSP whenever you want. You'll just have to pay taxes on that amount, and those taxes depend on your income. Whenever you make a withdrawal out of your RRSP, that amount you take out gets added to your taxable income for the year. If you have a high salary, you'll be in a high tax bracket, and so if you withdraw out of your RRSP, you'll pay a lot in taxes. Whereas if you made the same withdrawal out of your RRSP during retirement, your income will be much smaller, and so you'll pay much less taxes on that withdrawal. Let's go over a simple example. I'll be using the tax brackets for 2020, and for simplicity, let's not look at provincial taxes. I'll only be looking at the federal taxes. Let's say I have a large income of $100,000 per year. I've covered how tax brackets work in my previous tax videos, so I'll go over this very quickly. I totally fill up the first tax bracket at 15%, then I completely fill up the second tax bracket at 20.5%, and now my remaining income of $2,931 goes into my third tax bracket with a 26% marginal tax rate. So in total, I pay almost $18,000 in federal taxes. Provincial taxes would add even more. Now let's say I do something stupid. Let's say I want to buy a boat, which costs $20,000. There's nothing wrong with buying a boat if I could pull that cash out of my savings account or even out of my TFSA if I had to. But in this example, I'll make a stupid decision and I'll withdraw that $20,000 out of my RRSP to buy this boat. I'm allowed to do this. I won't be slapped with any additional penalties for withdrawing before retirement, but I will be taxed heavily because of my large income. So now, this $20,000 withdrawal gets added onto my taxable income. So when I file taxes, I'll be taxed as if I made $120,000. So let's go through it. Once again, I max out the first tax bracket and I max out the second tax bracket. But now, I have an extra $20,000 that will be taxed in my highest tax bracket with a rate of 26%. So in total, I will pay over $23,000 in taxes. I wanted to buy a boat, and by withdrawing $20,000 out of my RRSP, I am charged 26% out of this $20,000. So I lose $5,200, all because I withdrew from my RRSP while I was in a high tax bracket. If my salary was even higher, or if I withdrew a larger amount, that withdrawal could have bumped me into an even higher tax bracket, costing me even more in taxes. Let's see what happens if I make the same withdrawal during retirement when I have a low income. Let's say I have a pension which pays out a small amount of $20,000 per year. In this case, my entire income fits in the first tax bracket, so I only pay 15% of this. So we pay $3,000 in federal taxes. In fact, for such a low income, after tax credits and tax deductions, you'll barely be paying any taxes at all. Now let's see what happens when I withdraw $20,000 out of my RRSP. Just as before, this $20,000 RRSP withdrawal adds onto my taxable income. So when I file my taxes, I'll be taxed as if I made $40,000 a year. Luckily, this still fits in the lowest tax bracket, so I will only pay 15% on this $40,000. So in total, I pay $6,000 in taxes. Since I'm in a low tax bracket during retirement, I only pay $3,000 out of this $20,000 withdrawal. Again, these examples only contain federal taxes. You'll also have to pay provincial taxes on these withdrawals. Let's look at the total taxes we would pay on these RRSP withdrawals. These amounts will come in handy in a few minutes when I bring up withholding taxes. Let's say that in both examples, I live in Ontario. So if I'm retired in Ontario with a salary of $20,000, I'll be in the first tax bracket with a marginal tax rate of 20.05%. That includes both federal and provincial taxes. And if I'm working with a salary of $100,000, I'll be in a high tax bracket with a marginal tax rate of 43.41%. When I withdraw $20,000 from my RRSP, I will pay the marginal tax rate on this $20,000 amount. So when I'm retired, I only pay $4,010 in taxes on this withdrawal. In fact, I would pay even less when I factor in tax credits when I file my tax return. Now, for the high income earner, I'm paying 43% in taxes on this withdrawal. So I will pay $8,682 in taxes from my $20,000. That's more than double the taxes I would pay in retirement. Clearly, you lose a lot in taxes if you withdraw from your RRSP during your high income years. But what if your income drops before retirement? What if you get laid off or you decide to start your own business and for a year or two you have very low or even no income? Should you withdraw from your RRSP in that case? You'll be in a low tax bracket, just like you would during retirement. So it's true, you'll pay very little in taxes on this RRSP withdrawal. You won't be slapped with any additional penalties for withdrawing early. You'll just pay the regular tax amount on that withdrawal. But you still shouldn't withdraw from your RRSP unless it's absolutely necessary. And that's because when you withdraw money from your RRSP, you do not regain this contribution room. That room is gone forever. This is very different from the TFSA, where if I withdraw $20,000 from my TFSA this year, I would regain that contribution room next year. But this doesn't work for RRSPs. As soon as you make a withdrawal from your RRSP, that contribution room is gone forever. You can never put that money back in. So for the rest of your life, you will lose that $20,000 of tax-free contribution room. If you really need money, take it out of your savings account or your non-registered investments, or even out of your TFSA if it comes to it. As soon as January 1st hits, you'll be able to put that withdrawal amount back in your TFSA. So you'll only lose a few months of tax-sheltered growth. But if you withdraw from your RRSP, you lose a lifetime of tax-sheltered growth, which you never get back. So don't withdraw from your RRSP unless absolutely necessary. There are two exceptions to this, the Home Buyers Plan and the Lifelong Learning Plan, which I'll get to in part 3. In these examples, I showed you the total amount of taxes you would pay on these RRSP withdrawals, but these taxes actually come in 2 stages. First, when you withdraw money from your RRSP, your bank or financial institution will immediately charge you a withholding tax. So if you withdraw $20,000 to buy your boat, you don't get this $20,000 in your hands. You immediately pay a withholding tax up to 30% and you get what's left over. Then at the end of the year, when you file your taxes, you will either receive a tax refund if you paid too much in withholding taxes, or you'll have to pay even more in taxes if there's a difference. Withholding taxes aren't a penalty. They don't increase the total amount of taxes you pay. It just forces you to pay some taxes up front and then pay the rest when you file your tax returns. Let's break down how withholding taxes work. If you withdraw $5,000 or less from your RRSP, you'll pay 10% in withholding taxes and you'll keep the rest. If you withdraw between $5,000 and $15,000, you'll pay 20% upfront. And if you withdraw more than $15,000 from your RRSP, you'll pay 30% right away in withholding taxes. Note that for Quebec residents, you'll have different tax rates. So let's return to our example where we withdraw $20,000 from our RRSP. This is the total amount of taxes you'd pay when you file your tax return. But since we're withdrawing more than $15,000 at once, we will be charged an immediate 30% withholding tax on this $20,000. It doesn't matter what our income is. In both cases, we pay 30% or $6,000 upfront in withholding taxes. This is important. We withdraw $20,000 from our RRSP, but the government immediately takes away $6,000, so we're only left with $14,000 in our hands. If I needed $20,000 to afford that boat, I wouldn't have enough. I would actually have to withdraw almost $29,000 from my RRSP to end up with $20K in cash. Again, please don't withdraw from your RRSP to buy a boat. But the point is, if you have a dollar amount that you need, plan ahead and prepare for these withholding taxes. Okay, so we received our $14,000 in cash, and we can do whatever we want with it. Now, what happens during tax season? Well, in the case of retirement, when we're at a low income, we actually overpaid in taxes. We paid $6,000 upfront in withholding taxes, but since our income is low, we actually only owed $4,010 in taxes. So when we file our taxes, we'll get this difference back, and we'll receive a tax refund of $1,990. But in the case of the high income earner, I paid $6,000 upfront, but that's not enough. I still owe the government more. So when I file my taxes, I'll have to pay them the difference. So I'll have to pay an additional $2,682 in taxes to reach my total. So even in retirement, when you withdraw that money from your RRSP, be prepared to pay that withholding tax upfront. Most Canadians in retirement convert their RRSP into a RIF, a registered retirement income fund. In fact, once you reach the age of 71, you are required to convert your entire RRSP into a RIF. I'll talk about this more in a later video, but a RIF forces you to withdraw a minimum amount from your retirement fund every single year and pay taxes on these withdrawals. By using a RIF, you can reduce or even eliminate the withholding taxes you would pay on these withdrawals. So you don't have to worry about upfront taxes. You only have to pay taxes during tax season. I'll be making a whole video on RIFs, and I'll go over different strategies to reduce the total amount of taxes you pay during retirement. And I'll go over key concepts like spousal income splitting and OAS clawback. So stay tuned for that video. There's a lot to talk about with RRSPs, so I'm going to have to make a part 3 of this video, where I will talk about the 2 special exceptions which allow you to withdraw money from your RRSP without paying any taxes. And that's the Home Buyers Plan and the Lifelong Learning Plan. These 2 programs can help you fund the purchase of your first home or fund post-secondary education for you or your spouse, but not for your kids. These are very popular programs, but there are some rules to consider, and they're not always the best route to take. So check out my upcoming video to learn more. In part 3, I'll also talk about what kind of investments to hold in your RRSP to maximize your tax-sheltered benefits. I know a lot of you guys have been waiting for this information, so I'll give you a super short summary right now. I reserve my limited RRSP room for high-yield US dividend stocks and US dividend ETFs. Just make sure you hold these ETFs in US dollars, not Canadian dollars. By holding these US investments in your RRSP, your dividends will grow tax-free, and you won't be paying any taxes on capital gains. Plus, you'll avoid the 15% US withholding taxes that you would be paying on US dividends in your TFSA. There's a lot to talk about with investing in your RRSP, so make sure you check out part 3 coming soon. And of course, if you'd like to get started with Questrade, which is my favorite online broker, especially for US investments in my RRSP, click the referral link in the box below and you'll get $50 in commission-free trades when you sign up. That basically means that your first 10 stock trades will be commission-free. That's $50 in savings, plus I'll get a small referral bonus as well. Also, I've been getting a lot of questions about Questrade's RSP account. The RSP and the RRSP are the same thing. Earlier this year, Questrade decided to rename their RRSP account to the RSP account, but nothing has changed. In my video tutorial on how to buy US stocks with Questrade, you'll see the account name RRSP in my Questrade, but if you open up an account now, it'll be called RSP. Don't worry, it's the exact same thing, it's just renamed. So there you have it, that's almost everything you need to know about RRSP withdrawals. There's no direct penalty for withdrawing before retirement, but you should still avoid doing so. Anytime you withdraw from your RRSP, that money will be taxed as regular income. But remember, once you withdraw from your RRSP, you never regain that contribution room. So you will permanently lose the tax-sheltered benefits on that money. Also, when you withdraw, you will immediately be charged a withholding tax. And then when you file your taxes at the end of the year, you will either receive a tax refund if you overpaid on those withholding taxes, or you will have to pay even more in taxes if you underpaid. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel, and hit that bell icon to be notified of my new videos every week. And if you'd like to follow me on Instagram or Facebook at Canadian T-shirt, click the links in the box below or click the links on my homepage. And be sure to tune into my next video on Norbert's Gambit, where I'll be giving a step-by-step tutorial on how to buy US stocks without paying any currency conversion fees. Thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.